Well, let's consider the goals and objectives of conducting an audit. As an auditor, whether you're an internal auditor or an external auditor, you need to understand why the company wants to conduct an audit of its intellectual capital assets. What is their goal? Some possible goals might be to better manage those assets, just as they manage their financial or their physical assets. They may wish to reduce their intellectual capital liabilities if they are becoming aware of them. They may want to make a statement about their intellectual capital asset stature in the industry in a way that attracts new talent and intellectual capital. They also may want to encourage current and potential stockholders to invest. They may be making a statement that would encourage a bank or a lender to decide to give them other kinds of capital, or just to simply build trust in their partner and stakeholders. So in a nutshell, an audit is a way of validating that the organization is doing what it says it is doing. In conducting an audit, again, whether you're an internal auditor or an external auditor, you are expressing an opinion on the fairness of the balance sheet and the statements that are under audit. There has to be some kind of a statement from the organization about what it is doing and what it thinks it is doing, though, for the organization to be auditable. When you conduct an audit, you need to be aware of some of the risks that attach so that you can avoid or reduce them. There is the risk of issuing an adverse opinion when one is not warranted. In other words, you issue a negative result. There is a risk of issuing an unqualified opinion when it is not warranted. There is a risk of not understanding the organization's business well enough and focusing on things that are what an auditor would call immaterial, or you might be focusing on assets that are immaterial. There's a risk of building on previous poor quality audits. Now, this is probably not a risk we're going to encounter unless the organization has conducted what it has called a knowledge audit in the past. But in fact, that was not an audit, it was a maturity assessment, et cetera. So it's unlikely that you're going to have a knowledge or intellectual capital audit to begin your work with. Another risk is that you might misjudge an organization's ability to identify and correct problems. So in your report where you're suggesting where you're assuming that they're identifying liabilities and proposing remedies to those liabilities may be underrepresented in the balance sheet. And this is a very high, this item carries a high probability, I think. There's also a risk of missing inaccuracies in the statements. And I think this is also probably a high risk when we're just starting out in designing and conducting intellectual capital asset audits. So I'd like you to step back and think about what might be a risk in conducting a knowledge audit of your organization. How would you mitigate this risk?